All right, welcome everybody to this evening's special call. I have actually been waiting for quite a while for this to be put on, and Dave Stech, who is actually going to be our featured guest speaker this evening, is a very good friend of mine, and I'm extremely excited to have him on. But before we get started, before I share a little bit about Dave and what he's about and have him go into this great presentation, can I just have everybody type in letting me know that you can see our screen? I want to make sure that you can see it. This is live right now. It's let me see here. It's about 9:01, 9:01 Eastern time. So I just want to make sure everybody could see our screen. Dave's going to get started here in just a second. So if we could have everybody just type in yes or no. We want to make sure that you could obviously see our screen and get everything worked out if you can't. So we'll go ahead
Yeah,
and
looks like they can. I think they can see us okay.
okay, perfect. Well, guys, again, thanks for taking time out of your busy schedules, and especially for those of you East Coasters on the East Coast time. Thanks for taking time out of your evening. Trust me, this is something that you will be able to walk away from tonight thanking yourself that you took time out of your schedule to watch and listen to this presentation. I'm actually myself going to take notes, listen to Dave. This is the type of person that is a business changer, and Dave actually speaks for people at Harvard Business School. So the information he's going to be giving away is extremely valuable. And unless you attend Harvard Business School, this is pretty much going to be the only way that you could actually hear Dave, unless he gets hired to, speak for other individuals that have seminars and promotions and whatnot. But let me give you a little bit of background on him before I go ahead and have him get started. Um, Dave is the founder and CEO of Purposeville Investments. It's a private equity firm that he's had, and he's been very successful at it. He's a serious investor. He's actually a money partner to myself and other serious investors. The one great thing that Dave's going to dive into, which might resonate with you or not, may or may not. Dave grew up in a trailer park for the first 12 years of his life, and since that time, he's come a long way. He's retired 3 times, and he's a multimillionaire. Okay, he graduated from the London School of Economics, and like I said, speaks at Harvard Business School. Okay, he's never lost a penny in one real estate deal in 30 years, and consistently produces double-digit returns for his investors. And he also helps out investors that have self-directed IRAs. Okay. Now, the one thing that I want to point out to you, some of you may know my background or not, but I was in the mortgage industry, and I wish I would have known Dave back then, back in '06 and '07, because he actually forecasted the real estate meltdown. Okay. So I would pretty much say this guy is extremely smart. You're going to walk away probably with a few extra points on your IQ just by attending this event. Um, he does only 3 things every day: make money, do good, and have fun. And right before we actually started this broadcast, we were both talking about how we're both fathers, and he, just the way he presented himself with telling me how he is as a father. Really, I know Dave. He's a friend, but we don't talk super personal all the time, and for him to share that with me was great. He's a very personal individual. And I have nothing but great things, and I'm honored that he would take time out of his schedule to do this presentation for us. So, without further ado, Dave, thanks for joining us this evening, and thanks for taking time out of your schedule to do this for us.
Well, it's my pleasure, Jason, and I hope everyone enjoys themselves tonight. The one thing that you didn't mention was the fact that when I forecasted that the market was going to implode back in 2006, it was actually at Harvard Business School. And for the next 5 years, they didn't invite me back because I was a nutto. I mean, no one actually believed that there was any way that the market was going to implode the way that it did. And I chose to put my money where my mouth was, and I told them on stage, the stage that you're looking at here, that I was going to sell out of our properties. And we sold over 300 properties in 2005 and 6, and sat on the sidelines in 2007 and 8 and watched it all happen. So it wasn't for another 5 years, last year actually, that they invited me to speak again. And it's amazing how I was an idiot back in 2006, and all of a sudden in 2011 I said the same thing, and I was a genius. Go figure. So it's interesting how that all plays out, but I'm glad everyone's joining me tonight, and I'm actually going to speak at the end of this month at Harvard again. So I'm looking forward to it, and hopefully this time I'll be able to share something new. And that's what I'm going to give you guys a little peek under the tent at. So Jason, appreciate the intro, and I'll see if I can't do you justice here. Folks, I'm going to jump in and kind of tell you how ironic that this is that I'm on this call. In fact, my assistant put this slide together for me just today. In fact, I dropped it in here about a half an hour before Jason and I got on the call, and she calls it the ironic juxtaposition. So basically this year in 2012, both Groundhog Day and my State of the Union tonight is actually occurring on the same day. And what's interesting is that it's an ironic juxtaposition of events. In other words, one involves a meaningless ritual in which we look to an insignificant creature of little intelligence for prognostication, and the other involves a groundhog. So I am that insignificant creature of little intelligence, and I'll be doing a little reflecting and a little prognosticating, and hopefully you guys won't get bored too badly. I'm going to blow through this because Jason's already shared a few things about me, and he mentioned I grew up in a trailer park, and I happened to go to Purdue undergrad and then the London School of Economics. He didn't mention this, but in corporate America, I happened to launch the first disposable camera for Kodak and the first digital postcard for Disney. The unfortunate part is I didn't get rich, so I became an internet entrepreneur. In fact, I was recruited to be the CEO of the first internet company that I was a part of in late 1999, and it was at the right time and the right place. And a year later, I early retired, and I did it 2 more times after that. And every time I early retired, it wasn't because of the money, although that was important, but it was because I had a mission to take life sabbaticals. And I never planned it this way, but the first one was with my oldest son during his quest to get into a great college. And I ended up I early retired, and I took off a few months, 6 months to be exact, and I traveled across the country looking at colleges with him and taught him how to market himself and package himself and campaign. Basically, everything we do in business, I tried to teach my son. Because I believe that you can either be a biological father or a great dad. You choose. I believe you can be a biological mother or a great mom. You choose. Well, all of us on this call have an opportunity to choose, and I just decided that I was going to be a great dad. And I decided it at an early age. Now, whether I am or not is not the point, but I try harder than anyone I know. And I also took another life sabbatical with my younger son 2 years later. And then 2 years later after that, I took my third life sabbatical, which was based on my dad having been diagnosed with the last and third bout with cancer. And 6 months later, he passed away. And so when you take life sabbaticals, not only is it important to those that you're helping, whether it's you or someone else, but I can tell you one thing. I made more money during those 3 6-month life sabbaticals, a total of 18 months between 3 people that I loved. I made more money in that 18-month period than I ever had in the collective time that I'd spent on the earth. So it's funny how that all works. And I'm not one of these, the secret type of guys or the universe, or I don't get all that. All I know is this, that when you do good, it comes back around. And as a result, I began investing in real estate 30 years ago, but it wasn't until this last decade that I took it way serious because I had the financial resources and I decided I loved it and I launched purpose-built investments. I did it to primarily take advantage of the pre-construction boom. You'll remember those days. Well, I got out in 2006, sat on the sidelines in 2007 and 8, got back in the game in 2009, tested it in the market of my choice with my own money. And then in 2010 through 2011, I bought up to 3 homes a day, and I launched 3 syndicated investment funds with just everyday investors. In fact, we called it our No Investor Left Behind Fund. Whether you knew anything about real estate or not, you could participate in our fund as long as you had the cash to do so. So it's been a pretty good ride. And it boils down to 3 things for us. And that's all we do. We do 3 things. We educate, we invest, and we lend. So we are, as Jason said, money partners for people like Jason and many others who you've probably heard of. And we do it this way. From an education standpoint, I don't sell a book or tape or a home study course. I don't have any of those things. All we do is we provide free market research and analysis. And our goal is to share and attract rather than pitch and close. So what we do are things like speak at Harvard Business School or speak to high net worth investor events. I was the keynote speaker this year at Equity Trust, which many of you probably know is the largest self-directed IRA custodian in the country. And we're doing something right now that's huge for 5 to 7 figure self-directed IRA investors. So if that's you, you might want to listen up. Actually, I won't have time to get into it tonight, but drop me an email. We also, from an investing standpoint, we partner with those that have cash. So those that have liquid cash or significant cash in their self-directed IRAs, they invest with us because they believe that we've forgotten more than they know about making money in real estate. And you may have a similar view after you hear what I have to say tonight. But the key is this: we do everything the opposite of how Wall Street works. So I invest my money first before you do. I'm the first money that goes into a fund. You get paid first. We don't charge any fund management fees, which is the exact opposite of basically everything that Wall Street does. And Wall Street's taken advantage of me. It's the only time I've ever lost money in my life. And if I have time, I'll tell that story tonight. And then the last thing is we're money partners. You know, we've got cash and real estate investors need it, like Jason and others. And so we do short sale flips. We do rehab flips. We just took down an 85 asset note portfolio that, in fact, Jason, one of Jason's colleagues, was involved in. We became their money partner. And that's both residential mostly and a little bit of commercial. And we do both debt financing like transactional funding and hard money, and we also do equity partnerships where we become profit partners with our investor partners. So that's pretty much it relative to me and to what we do. Let's talk now about our agenda, and it starts with Jason. You know, the truth is that if you enjoy tonight, I would thank Jason because my goal is to add value to him and by extension you. Of course, if you don't like tonight, you should talk to Jason too. Why do I do the State of the Union? And why do I do it for free? I mean, it costs me 6 figures worth of research each year and another 6 figures in staff just to create what I'm sharing with you for free. And the answer is because I've got to do it anyway. I've got to be the best informed investor on the planet. If I can be that and I don't lose money, then it's worth every penny because I can make so much more than what I spend. But my other goals are twofold. One, I want to educate 100,000 investors every single year to be the victors, not the victims next time around. You see, too many people lost their assets, and my goal is to help them. Now, when I speak at Harvard, I'll capture 2,000 right there. But there are a few hundred of you on the line tonight. So how cool is that I can reach out and provide value to Jason and by extension to you? And that's my do-good goal. Jason mentioned the three things we do. One is to do good. The other thing we do is share and attract. We're not trying to pitch and close. There's nothing here for sale. It's just about sharing and attracting like-minded people who see what we do and find benefit in it. And if that's you, great. And if it's not, if you're more curious than serious, then you're going to learn a lot tonight. And that's fine. Now, the truth is, I've got to be honest about what I do and what I don't know. I didn't know how to find bin Laden. I don't know how to stop immigration coming across our borders. I don't know how to cure the health care crisis we've got in the U.S. I don't know anything about oil and gas or the stock market or precious metals, but I know real estate. And we do an enormous amount of real estate research. And that's where it starts. You see, there's three things that every day you do, but you don't realize there are three buckets. There's the necessary bucket, the nice bucket, and the neither. You shouldn't be doing things that fit in the neither bucket, and you shouldn't be doing the nice stuff until you've accomplished the necessary. Well, research isn't nice, it's necessary. And what you're going to see tonight is maybe 10% of what we create. In fact, there's over 700 slides that basically formed the foundation of what you're going to see in less than an hour tonight, and it only involves 2 states. You're going to see economic and demographic and housing market research, and all I ask that you do is stay engaged, and I'll try to help you a couple of times along the way. And I'm going to go quick because we have so limited time tonight, because I spoke at Harvard for 2 days last year, and I don't have 2 days with you tonight. So we're going to do the best we can, and I've got good news and bad news before we jump into it. As I said, there's nothing for sale. This is pure content. It's an incredible amount of it, and I wish I had had the same thing. So I always try to do presentations as though the roles were reversed. If I were you, what would I be looking for? And I can tell you that there's no way I can cover all of this in one webinar. So what I've agreed to with Jason is at the end of the evening, I'll leave an email invitation to the second part of this. It's going to be much like the first part. The difference is this. Tonight, I'm going to educate you. I'm going to give you an incredible grounding and a base on which you can build your foundation for doing deals. Then, on part 2, I'm going to share all the deals. I'm going to share all the results. It's the juicy part of the presentation. So if you can enjoy tonight, I promise you, you will love the next one. And all I'd like to do is ask a favor. If you're impressed, just tell others about the next webinar. I think Jason deserves it for having invited you on this call, and I hope that I will have earned the trust that you have. And I can tell you this, 82% of all of our clients invest more than once, and 54% refer someone else who actually becomes a client. So we have what we believe to be the best ethical, high-integrity, lifetime client model in the industry. And, I don't know how many people you know that speak at Harvard Business School, but probably not a lot. And we don't get invited there just for giggles. We get invited there because we're going to share the kind of information you're going to get tonight for free. So, my whys. I have 2 primary whys I want to share with you because it's going to help you understand more about me and more about where we're going over the next 2 webinars, including tonight. Number 1, in 2010, I opened up a Roth on April 14th. This was a Roth IRA at Chase Bank, and I opened it specifically so that I could show you what I'm about to show you now. You see, I opened it, and this was my retirement account deposit receipt. You see, here's my name. I opened up a Roth. It was a regular Roth deposit. It was for calendar year 2009, and it was before the deadline of April 10th of 2010. Because I'm over 50, I was able to deposit $6,000 instead of the normal $5,000 and check out the interest rate. Now, if you glance at that quickly, you think to yourself 1%. No, that's 1/100th of 1%. Now, think about this for a minute. An IRA cannot be taken out until you're 59 and a half without penalty. So I'm the most loyal client they're ever going to have because I can't take the money out, and they're going to reward my loyalty with an interest rate of 1/100th of 1%. That is one of the many ways that Wall Street, and in collusion with our government, is actually taking advantage of you. And that's why you need to do something about it. 1/100th of 1% of $6,000 is 60 cents a year. Now, how stupid is that? And it gets worse. At the bottom of page 1, it says penalty for early withdrawal. In other words, if I take my money out too soon, they're going to actually take some of my 60 cents. Now, how ludicrous is that? I don't want that happening to you. I want you to take control of your financial future and not allow others. And oh, by the way, do you think there's any chance that those who are managing your IRA are getting commissions? Are they getting fund management fees? Are they losing your money at a time while they're making money? All of the above is true. The second why I have are my sons, and I mentioned this earlier. Believe it or not, he is my older son, even though he looks like my younger son, and he graduated with honors from Berkeley, and Josh actually has 3 degrees from Stanford, including his master's. He is now our CFO, and he is now our CMO, and I get the good fortune of doing everything I'm about to share with you on the next slide with my sons every day. Now, you tell me how much better that gets than that. It just doesn't. So I'm the luckiest guy on the planet. You got him right here. Forget Harvard, forget all the other stuff. I'm the luckiest guy on the planet, and you happen to be on the call with him. And I'm not kidding, because what I get to do is execute on my personal plan every day. I get to make money, do good, and have fun, and I get to do it with folks like you. Now, how cool is that? I don't have to work for a living. I don't have to do anything, and I chose to try to help Jason tonight, and by extension, you. We're going to start by talking about making money. Because you see, you can be Mother Teresa and do all the good in the world, but if you're limited in resources, you're limited in the amount of good you can do. I make more money every day. It allows me to do more good every day. It allows me to have more fun every day. And oh, by the way, because I've made more money, I can make more money. So this is a pretty cool concept. And all we're going to talk about tonight is making money, because it starts with top shelf education. It is absolutely critical that you understand what I'm about to share with you, because it will make a better informed investor out of you, and it'll make a difference in your financial future. Because the money game is always the same. It's only the strategies that change. You see, I created what I call the money game in terms of realizing after most of my life that I hadn't conquered the world. And all of a sudden I figured out this money game. And it's really 3 things. Generate cash, otherwise known as income, accumulate wealth, otherwise known as assets, and keep as much of both as you can. That's it. It never changes. It never gets more complicated. The strategies change all the time. And the 6 ways to profit will be different next quarter, and the next quarter, and the next quarter, and the real estate cycle will change all the time. You see, there's 2 primary cycles that we go through in real estate. The first is a transactional cycle, and the second is a wealth building cycle. Right now, we're in the transactional cycle. The way to make money right now is to do a lot of transactions and generate a lot of income. When the wealth building cycle comes around, we're going to want to buy and hold and accumulate assets and do 2 things that contribute to wealth: appreciation and leverage. In other words, if you're in a market that's going up 5 or 10% per year, and you can buy homes with 20% down and leverage the other 80%, if you look at the compound effect of those 2 things, that's what allows you to accumulate wealth. And the third and most important component of this thing is to keep as much of both as you can. And that's why I am so passionate about self-directed IRAs. I'm actually launching a self-directed IRA mastermind group, and I'm only doing it not for the money because I don't need it, but because I'm trying to find like-minded people who have 5 or 6 or even 7 figures in their IRA, or they have it in liquid cash, because that group can do some serious damage in the marketplace while America's on sale. So talk about excited. That's what gets my juices flowing. So tonight we're going to talk about education. I'm going to give you the knowledge that I have distilled into what I would normally spend a lot of time at Harvard talking about. All I ask is that you combine it with action, because if you can take what I share with you and combine it with action, I think you're going to be able to have the freedom that I enjoy. And it starts with the first way to profit. Profit through research. Again, research isn't nice. Research is necessary. And yet, almost no one does it. Now, I do it because I'm just anal about it. You know, I went to the London School of Economics. In fact, if you Google dumbest guy to ever go to the London School of Economics, my picture actually shows up, I think. The people I went to school with there actually owned countries. It was just unbelievable. And it made me realize that it was about fewer better people and fewer deeper relationships, not about trying to network at a RIA with the masses of asses. I'm telling you, that's not the answer. Find fewer better people in your life and you will get rich in a short time. Now, let me share a little bit about the kind of research we do. We track over 300 MSAs, which is an acronym that stands for Metropolitan Statistical Area. And of the 300, they fit in different buckets. This happens to be the emerging market bucket. Not a lot of those right now. Then there's the counter-cyclical bucket. For example, I live in San Diego, and there's a market that's exactly counter-cyclical to San Diego, and it's called Salt Lake City. For whatever reason, Salt Lake happens to go up when San Diego goes down and vice versa. Well, if you knew where the emerging markets were, if you knew where the counter-cyclical markets, and while I don't have a slide for it, if you knew where the best cash flow markets were, and what if you could layer them on top of each other and put emerging and counter-cyclical and look at the trends between them? How cool would that be? Well, that's what we do. And our goal is not to figure out the best 25 markets in the country. How about if we just figure out the best one and invest there? Well, we did not long ago. But I'll get to that in the future. Our competitive differentiation, therefore, is that we're dead serious investors. We're not realtors. We deal primarily developer direct and bank direct. Why? Because when the market is going up, we're dealing directly with developers to buy pre-construction properties. When the market's going down or at the bottom, we're buying bank direct like we are now. We're not married to any market. As I said, I live in San Diego, and the mantra in our office is live where you want and invest only where the numbers make sense. That's it. Right now, the numbers don't make sense for me to invest in San Diego, but they make sense for me to partner with others utilizing our cash because we can make money together. We and our investors, and we have lots of investors, have a lot of money in play. So I can't afford not to do research, and when I'm sick of it, we do more research. Our goal is to deal only in facts, not in hype, and it's worked because our results reflect it. So let me explain some of this to you, because I think you're going to really find this interesting, and I think you're probably going to be nodding your head a lot during this conversation or in this webinar. This happens to be the California housing market cycle. It goes way up, goes way down. You know, as you can see, the difference between selling 500,000 homes in a year and 200,000 is a precipitous decline. Then it goes up, then it goes down, then it goes way up, way down, way up again. Why am I even showing you this? Well, here's the deal. There are 4 states in the United States that are exceptionally volatile. You may have already figured out what they are. California is one of them. And volatility equals opportunity. You see, back in 2006, when I knew we were here and I got out, I took advantage of sitting on the sidelines and then waiting for this to happen. Remember, I got back in the market in 2009 testing my own money, and in 2010 and 11, we've gone all in various ways. Well, if you were to look at California and compare it to the U.S., you'd see those bumps that we just talked about that look different on this chart, and there's that big one and that big decline. Well, the U.S. historically has grown at 6 to 7% per year in average annual appreciation. All of a sudden it went up here, At the same time, California went up here. Well, actually, it didn't really go up that much, but because California is the 8th largest economy in the world by GDP, tied with France, the country, all of a sudden this bump became largely a result of this big bump here. And otherwise, the market in the U.S. really doesn't change an awful lot, but it is now overcorrected. And that is great for investors. I'll show you a little bit of research on California. We just got actuals for the full year 2011. And while not all of you are in California naturally, you could do this in your state too, but I'm showing it because most of those of you on the call tonight are from California, not surprisingly, because of its population and because there are a lot of investors in California. In July 2011, I showed this slide, and it was basically to show a couple of things. First, here are the years and months down here, and as you can see, this peak in unit volume, see all this booming business right here, it peaked right about here, which was in 2005, 2006. The peak actually occurred roughly, in the second half of 2005. And yet it started dropping like a rock in units. In other words, demand fell off the face of the earth, and yet consumer confidence here in black kept going up. Why in the world would that be when units are going down the toilet, demand's going down the toilet, consumer confidence is going up? Then all of a sudden demand started coming back and consumer confidence started going down. And it's because there's a lag time of usually 1 to 2 years between what's actually happening and how people view it as happening. And in large part, that has to do with the National Association of Realtors and the California Association of Realtors in this case, being I'll call it the confidants that report to the media and the media in turn to you. So when the market is going down the toilet, you're not going to hear realtors talking about it. They're going to talk about how price is going up, and if you don't get in now, you'll never be able to get in. And at the time that the market goes down here, they're going to say, oh my goodness, now all of a sudden demand is going up, and if you don't get in now, you'll never be able to afford it. Well, it's basically the same story with a different spin. So when you look at sales, you see that unit sales dropped precipitously from 2005 to 6 to 7. So look at this for a minute. Down, down, up, up. Let's just go with that. From 2005, down, down, up, up. Now let's look over here. I'll come back to that slide, and let's look at price. Up, up, down, down. Well, isn't that weird? It was the exact opposite of what unit sales were doing. Well, what it meant was that all of a sudden people started figuring out that things were not good. Well, look, I was back here speaking at Harvard back in 2006, all right? I was right about in here, and I had seen that it had dropped like a rock. I had looked at the corrections that had occurred in 79 and 80 when the U.S. real estate market hit a tipping point after it had doubled and then crashed. The next tipping point was in 89-90 when it had doubled and crashed. And here we were in 2006 where prices or in 2005 and 6 when unit sales were dropping after it had tripled. Well, that only meant one thing. It was only a matter of when, and the whole house of cards was going to fall because all of this unit sales decline was occurring. So it couldn't last forever. Sure enough, here's what happened to price in 2 years. And in fact, if you look at it on this chart, you'll see that it reached its peak. Remember, unit sales reached its peak in 2005, and yet price reached its peak in May of 2007, and within 21 months had dropped 59%. So the moral to this story is that when price is just on a rocket ship, that is really cool, and you see double-digit increases year over year. But it can happen a lot quicker the other way. Look at the slope of this line down. Now, it is certainly stabilized here, and that's good news, but we are still down 52% from its peak in California, and I don't see it coming back anytime soon, even though you're hearing about how the economy's improved and all of that. So At the end of the day, we track all the counties in the major MSAs that we track. So we know that, for example, all through California, these declines are occurring. Sure, there's the odd increase, but that's actually November 2010 to November 2011, so it's only month to month. But we track all of these counties, and we don't need to go through them here, but if you live in California, you've probably already glanced at yours. What else are we seeing going on in the market? Well, what we're seeing is a decline in terms of inventory, and that should bode well for those who are expecting a price increase. I don't think it's going to happen for two reasons. One, there's a rationale between why price is not increased and why inventory is low. And right now, there's the potential, since so much of the low inventory has been manipulated by the banks in collusion with our government, because our government doesn't want two things. One, a real estate adjustment or correction, again, because it will trigger a depression, not a recession. And number two, a drop in consumer confidence during an election year. So nothing significant or out of the ordinary is going to happen this year. So if you think it is, it's not. It's basically going to go along as is, nothing good, nothing bad. Yeah, there'll be the spot or two of good news or bad news, but at the end of the day, we're not going to see any signs of a economic improvement that's anything other than short-lived. And at some point, the banks are going to have to start releasing inventory, and I could imagine a double-digit correction in our future. If you look at inventory, you'll see that at the higher price points, we track it in 5 different price points in California, and you can see how it's roughly double at the $1 million or so price point what it is down here. You'll also notice that if you're a buyer of $1 million homes in California and you're on the market for one, this would probably be a good time to be looking, because at the peak of the market, we saw sales of 50 to 55,000, and it wasn't more than 3 years later that it dropped by 67%. While it's recovered slightly, it's not even half of where it used to be in terms of volume, and it won't be there anytime soon, if ever. Furthermore, if you look at median price in the market, median time rather on the market, you'll see that it's increasing. Now, how is that? I mean, if inventory is the lowest it's been in a while, and if prices are less than half price, and we'll show interest rate in a minute, and it's at record lows, why is it the days on market are as high as they are? We'll talk about that in a minute. How about housing permits? Well, you can see that housing permits are off between 80 and 90%, but people are still applying for permits. And why is that? No different than buying a new car. Whether new cars are a great deal or not, and the fact that I'm buying homes now for half of replacement costs that are less than 10 years old, there are some people who just want the new car smell. There are some people who just want a new home. And it doesn't matter that they're overpaying for it. They just want a new something. And that's always going to be the case. So you'll never see housing permits drop to zero. But look where it is. It's at the lowest point in the last 25 years in California. So it's not coming back anytime soon. How about affordability? This is something I wanted to spend a little time on because it's so important. You see, there are 3 things that make up affordability, or the affordability index. There are 3 variables, and the reason that this is even used is to give an indication of how affordable something is, in this case, real estate. The first thing is income. You know, how much does income change every year? Well, generally, average annual income and household income goes up by 1 to 3%. Of course, when you're unemployed, all of a sudden, it goes down 100%, but generally speaking, it doesn't change much. The second thing that affordability is based on is housing prices. And the third thing is interest rates. We're going to talk about those tonight because it really makes a difference. You see, when there's a drop in interest rate for first-time home buyers, all of a sudden this interest rate is at ridiculous lows. We're actually at a 53-year low in terms of interest rate. Well, look what happens to affordability. A higher percentage of households can buy because financing has dropped. Well, what else is that a function of? It's a function of sales price. So when sales price drops in half and interest rates drop, think how affordable it's become. Those are the two compelling things that drive affordability. And if you look at first-time housing affordability index versus median price, what you'd see is that median prices dropped, and all of a sudden it increased a little bit because there were incentives by the government, the first-time home buyer credit that you saw in here, and all of a sudden affordability is greater. Well, if you look at the proportion of first-time home buyers, back when that first-time home buyer credit was given of $8,000, you saw a peak at about 47%. Now, the number of first-time home buyers in California is down to about 34%. Again, you could do the same, well, I don't know that you could do it, but the same information could be analyzed and aggregated and put into a presentation like this in any MSA. Just so happens I live in California, so I keep an eye on it. How about median price? If you were to look at the median price of homes compared to the median household income, you'd see that back in the heyday, back when the market was on a tear, a home price was roughly 10 times whatever the household income was. It has since dropped in half. So it's exceptionally affordable to live in California relative to what it's been in the past. So let's talk now about population. This is so important, and this is probably one of the three most important things I'm going to tell you tonight. If you were to look at population in California, you'd see that it goes way up, it goes way down, it goes way up, it goes way down. I wonder why that is. And especially when you look at the U.S., which you'd expect to be a little flatter, but it's really 1% every year. You're not going to be able to do anything to change that. Well, what you have to look deeper into are the two things that drive population. The first is natural increases in population. That's simply births, new children being born. And the second is migration, and that's net migration in and out of the state. So if you were to look at this reddish-orange bar here, you'd see that the number of new children being born every year is about the same every year. The big difference is down here, and it's the number of people either moving in or moving out of the state of California. Well, why would they even move in or out anyway? And the answer is here, and this is the key to understanding why we are where we are in California relative to home prices and demand. There's net immigration and there's domestic migration. Immigration, of course, people coming across the California borders from either Mexico or the Asia-Pacific Rim. And migration is people either moving in or out of the states, in other words, between states in the U.S. You can see that net immigration, basically like natural births, and that is, it's basically 200,000 a year. You know, no matter what you hear from our politicians, they aren't stopping it. It's 200,000 a year. The big difference is down here, and this is the number of people who move in and between states in the U.S. You see, there are 9 states that people generally flee to when California becomes unaffordable. And when the affordability index gets down to 16 to 17% across the board, based on the way it used to be reported, all of a sudden, in the last 3 cycles, we've seen movement of people out of the state. So I knew that that was likely to happen, and as a result, it was just about that time that I got out of the market, just a little before. Well, you could track this too, not as empirical as the data that I've just given you, but more just by going to uhaul.com. If you were to have gone to uhaul.com back on September 5th of 2009, you would have seen the 9 states, and I picked 9 cities within those 9 states, where people tend to migrate to when they leave California. And isn't it interesting that if you went from San Diego, where I live, to Dallas, it would cost you $1,227 to rent a 17-foot truck for the same amount of time that it would cost to rent a truck back from Dallas to San Diego for $540. Now, wait a minute. How could it cost 2.5 times as much to use the same truck from San Diego to Dallas as Dallas to San Diego? I mean, I don't know about you, but I'm not the brightest bulb in the tree, but the last time I looked, it was the same exact distance from San Diego to Dallas as Dallas to San Diego. And the answer is there are more people wanting to leave California for Dallas back in September of '09 or any of these other cities, so that there was a multiple, and therefore you can pretty well get a gauge for demand. People were moving to Dallas. People were moving to Boise. People were moving to Denver and Salt Lake. Well, isn't that interesting? Now let's fast forward 2 years. This is June 5th of 2011. All of a sudden we see down here in Salt Lake and Seattle that people are actually moving back to San Diego from these cities, and it's reflected in the pricing of U-Hauls. Now, I'm not saying that this is 100% perfect, and it's certainly far from empirical data, but isn't it interesting that you could do the same thing in your city and get a sense for what kind of migration is coming in or moving out of your town? And that might give you an indication of where your market is heading. The other thing, of course, we talked about earlier was mortgage rates. And when the federal funds rate back in 2009 hit 1/4 of 1 point, it was just a matter of time before interest rates followed. So in this case, you can see the adjustable rate mortgages, and in this case, fixed rate mortgages. Isn't it interesting that they've dropped like a rock? And as a result, we are at the lowest point in fixed rate interest in the last 50 or 53 years, and we're at the lowest point in price for a long time. So the combination of those two things mean that people ought to move back to California. So if prices and interest rates have dropped so much in California, why aren't they moving back? Well, they should, but they aren't. And they aren't for one reason. There's no employment growth. In fact, if you were to look at the significant hit that the California employment market took back from 2008 to 2011, you'd see that it's going to take us some time to recover from where we've been. And if you look at unemployment or the unemployment rate, you'll see that California is still at about 11%. The U.S. is about 9%. And for those of you who aren't familiar with unemployment rates, these numbers are artificially low. They're always at least 3 to 5 points higher than that which is reported, because a number of people aren't taking into account those whose unemployment benefits have expired, those who go from full-time to part-time. There are a lot of people who aren't factored in, so whatever is reported in the media, just add 3 to 5 points, and you may be able to get up to a realistic number. What has happened as a result of that? Foreclosures have been rampant. Now, this is no surprise to anyone. I didn't expect that it would be, but I can tell you this. This level that we're at right now is not only historically significant, but it's lower than it should be. Because if all the homes that were in foreclosure or delinquent or had notices of default would actually pass through the system in a free market economy without government or Wall Street intervention, it would be a lot yellower than you see here. You can also see that the ratio of foreclosure to notices of default is at about 50%. You can see our delinquency rates in black. I know it's a little difficult. Hit a peak of about 11% in California and are now at 7.6%. And foreclosures hit a peak of 6% and are now down at just around 4%. But again, these are artificially low. They should be higher than that if there were a free market economy where everything was left alone. The number of households by ethnicity is interesting because, as you'll see, the growth in the Caucasian population as compared, say, to the Hispanic population has changed considerably. In fact, in LA, roughly 55% of Los Angeles is now Hispanic. In terms of home ownership rates, you can see that that has dropped. And I'm showing you these slides not just for giggles, but because they'll become apparent in terms of their value when we get on part 2 and you see some of the things that we're doing. So in the case of home ownership rates, you can see that they have dropped, which is good for landlords. And if you were to look, you could actually, based on 2000 census data, and 2010 is not available yet, you'd be able to see where the best opportunities are. How about distressed sales by county? Well, we actually track this, so we know, and it's important to track it because in Marin County, for example, the number of distressed sales is only 1 out of 4, where it's 3 out of 4 in Solano or in San Bernardino. Do you think that's important for an investor? Of course it is, because what it means is that the number of bank-owned, REOs that is, or short sales is different by county. And so if you're looking for specific counties with high, high percentages of short sales or REOs, if you do your research, you'd know exactly where the fish are, and that's where you could fish. In addition to that, it's amazing that the amount of cash to sellers is at record lows. So in other words, for sellers who walk away from the closing table, back in 2005 at the peak, they'd on average walk away with $220,000 in net cash. Now it's about $35,000. Is that amazing? It's less than 10%, or I'm sorry, it's about 15% of where it was. And you'd think that there'd be no buyers with cash. Au contraire, there are a lot of buyers with cash, but there are people like me who operate investment funds, or people like you if you happen to be an all-cash investor. We loan a lot of money or partner with a lot of people as money partners on a lot of deals, which inflate these percentages. So I'm taking a deep breath and checking in with you. We're making great progress, and we're going to be under an hour tonight, but I wanted to check in real quick and make sure you were still with me. So I'm going to reward those that still are by giving you a little gift. I'm going to tell you a story about an investor that thinks outside the box rather. And it's an investor, this little guy, who's talking to his investment counselor. And he says, "Bless me, Father, for I have sinned. I have been with a loose girl." And the priest says, "Is that you, little Joey Pagano?" "Yeah, Father, that's me." "And who is the girl you were with?" "I can't tell you, Father. I don't want to ruin her reputation." Now, Joey, I'm sure to find out sooner or later, so you might as well tell me, was it Tina Minetti? "I cannot say." "Was it Teresa Mazzarelli?" "I'll never tell." "Was it Nina Capelli?" "I'm sorry, Father, but I just can't name her." Now, Joey, was it Kathy Puriano? "My lips are sealed." "Okay, Joey, was it Rosa D'Angelo then?" Father, I told you, I cannot tell you." And the priest finally sighs in frustration and says, "Joey, you're very tight-lipped, and I admire that. But you've sinned, and you have to atone. Now, I want you to go back to your seat, go back to the pew. You cannot be an altar boy now for 4 months. Now go and behave yourself." So Joey walks back to his pew with his head down and sits there quietly, and his friend Franco slides over, and he said, "So, Joey, what'd you get?" And Joey said, 4 months vacation and 5 good leads." Now, why do I tell you that story? Well, Jason and I want more time off. You should want more time off. How would you like 4 months vacation every year? And what if you could do it by having more good leads? Now, I'm not going to sell a lead generating package to you, but I can tell you that the new leads we get, the more clients we get, the quicker it is to get to where we're going quicker. And the quicker is to get to where we have financial freedom. And that's what I wish for you. So we then talk about the number 2 way to profit. And I'm going to go through this pretty quickly and start with what I forecasted in November of 2009. You see, I'd been sitting on the sidelines in 2007 and 2008, and then I got my own money back in the game in 2009, and I tested it. And why did I? I saw that Las Vegas had the highest number of homeowners underwater. And everyone said, whoa, that's not where you ought to be investing. Nevada, Arizona, Florida, Michigan, California, Ohio, they are so far upside down, that's where you want to stay away from. Well, not necessarily. I actually like the fact that there are problems, because problems provide opportunity. Remember, volatility equals opportunity. Furthermore, if you were to invest, say, down here at the bottom in Buffalo or Pittsburgh or Boston or Cleveland, you'd be looking at homes that are right around 50 years old. By contrast, Las Vegas's market is 15.8 years young. In other words, the homes that I'm buying in Vegas are almost all 10 years old or newer, generally 5 to 10 years old, built in the peak. Well, there's no deferred maintenance. They are not dated homes. They require light to no rehab instead of heavy. How cool is that? Furthermore, we were tracking at that time, back in 2009, the precipitous decline in existing home sales. And it appeared to be flattening a little bit, but, that doesn't necessarily mean a trend. Well, new home sales had dropped as well, but not nearly at the rate that existing prices had. And rent rates were kind of holding their own, but starting to soften. Well, I looked at it from a rent to price ratio standpoint and said, in the new home area, I thought that there was still some room to go because low is better, and we hadn't reached the low that we had back in 2001, a decade earlier. But in existing homes, it had dropped like a rock and was now down to a multiple of 12 compared to the historic 16. Remember, lower is better. We also looked and saw that bank-owned properties had dropped. The number of acquisitions and dispositions had increased. And we then looked at the 6 different areas that we carved up in Las Vegas, and we saw that the price per square foot had dropped in every area and had dropped considerably, but was starting to level out, as you can see here. We also looked at these consumer indices. Remember how I showed you before the Consumer Confidence Index? Well, that's in red here. But we also looked at 2 other indexes. The Expectations Index in green, that meant people were looking forward to better times to come, and the Present Situation Index, which was low. So they were at what they thought was the bottom and that good things were to come. Now, that may not have been true, but it's the psychology that we were trying to get an idea around. Furthermore, if you were to look at rental rates, we'd seen them soften, and that was a function of vacancy having gone up. We also looked at unemployment, and it had reached a national high. In fact, Detroit was the only area that was worse. And all of a sudden, if you looked at it compared to the U.S., it was really bad. We also looked at visitor volume and gaming revenue, and we saw that in the case of visitor volume, it had dropped off, and gaming revenue had dropped off quicker. So that was a reason for concern. High unemployment, dropping visitor volume, dropping gaming revenue. And we also looked at ethnic shifts. And you can see here that all of a sudden there was a shift, not surprisingly, where the percentage of Hispanic was going up pretty considerably in Las Vegas. In addition, the household income had not yet taken a hit at that time. And so we made a prediction. Now, keep in mind, back in 2006, when I spoke at Harvard, I said that I thought the market was about to implode and got out of over 300 of our assets. I only had 3 properties left when it was all said and done, and all of them we owned free and clear. Well, at that time, I said it was time to sit on the sidelines, and we did, and sure enough, things went to hell in a handbasket. But in 2009, I thought Las Vegas would be the #1 buy market in the U.S. by 2011, and I went on record as saying that, and everyone thought I was nuts for all the obvious reasons. Well, it turns out that in 2011 and this year, Forbes and Fortune and the Wall Street Journal and everyone is promoting Vegas as the #1 buy market in the U.S. Well, how did I know that? Well, I'm going to share a little bit about it tonight, and I'm going to share where we ended up in 2011. I believe, and I'm not the guy that takes credit for this, it's really Isaac Newton, who once said about the law of gravity, for every action, there's an equal and opposite reaction. Well, sure enough, when the market went up by that amount, remember, Las Vegas had been below the U.S. market in terms of home price. It had been tracking below, and all of a sudden just went off the charts. Well, for every action, there's an equal and opposite reaction. And now look how much cheaper Las Vegas is than the rest of the U.S. In fact, if you look at it on this chart, you'd see what I was just sharing with you, which was for every action, this 40% bump, there's an equal and opposite reaction, a 40% drop. It just took 5 years between the two. Well, if you were to look now at the number of U.S. mortgages in negative equity, you'd see Vegas is still in trouble, but many of the other markets have recovered much better. And as a result, if you were to look in Vegas, you'd see that, remember that significant decline I showed? It's pretty much leveled out, and that's what we expected it to do. Am I saying it's at the bottom? No. I'm saying it's at or near the bottom. And in the case of new prices, the same. Rents have softened a little bit, so as a result, the rent-to-price ratio has actually increased a little. Remember, the lower the better for investors. But we are still at a historic low. In fact, we are at a point now where the combination of interest rates and the combination of prices is at the lowest that it's been in the last 25 years in Vegas. In fact, home sales in Las Vegas, and I'm not here to promote or sell anything in Vegas, I'm just sharing with you the research, and basically the peak of the market had home prices at $287,000, and last month we ended the year at $104,900. That's a drop of 63% from the peak. Now, there's no other market in the country that's really taken a long, sustained hit of that magnitude. Plenty of other emerging markets, quote unquote, have taken a 50% hit, but that's about the biggest one, and it frankly should have. Because if you look back at what had happened, you know, there's a little bit of growth year to year to year, and then all of a sudden there was this meteoric growth. Well, again, for every action, there's an equal and opposite reaction. So I believe that the prices we're at right now, which are right around $100,000 for a single-family home, are unprecedented. In fact, if you combine sales price declines with interest rates declines, what do you find? Well, you find two of the most critical components of affordability. And if you then look at rent, which had increased and now softened but has stabilized, and I believe rents in Vegas will go up between 5 and 7% in 2012. The combination of those things is charted here. Now, what does it all mean? I mean, it's a pretty chart, but what does that all mean? Well, if I were to ask you, in the last 25 years, in this whole period of time you see down here at the bottom, in the last 25 years, how many years has Vegas actually had positive cash flow? What would you answer? 10 years? 15? 20? Well, it's been 3. And you see, we tracked this data, so we knew exactly where the market had been and how everyone was buying everything in the 2000s. In fact, they would buy 5 homes at once, even though the cash flow was at record negative levels. And yet we knew that it was about to go positive and be the best and only 3 years out of the last 25 years where there's been positive cash flow. Now, knowing this is like cheating, isn't it? I mean, wouldn't you like to have known all of this? Jason said at the outset he wished he would have met me before 2006. What I'm sharing here is not rocket science. It's just that other people don't do the research. And as a result, they're rolling the dice, or worse yet, they're listening to realtors tell them where to invest. Now, that doesn't mean realtors are bad people. It just means that they're not educated on economics and demographics and housing market trends. So at the end of the day, I want you to always think about where you get your advice. Remember when I had suggested that Vegas would be the #1 buy market in the U.S. by 2011? Well, here was a report done in 2010. It was the first one that said that Vegas was the #1 buy market in the U.S. Now, by contrast, let me explain this. If I said New York City, would you like to buy or rent? You say, well, I've got to rent. I can't afford to buy. And so it's the last buy market that you'd ever want to be in. By contrast, Las Vegas is in a unique position. It's cheaper to buy than it is to rent from a mortgage payment standpoint. And yet, why don't more people buy? Because they're all underwater, and as a result, their credit is shot. So this is the opportunity for us as investors to buy rental property and to come in and be able to take advantage of a market that they can't take advantage of themselves. And what we did is we created a market analysis system. Its purpose was simple. What if we could segment the market by zip code, price, size, and property? so we could determine the optimal investment parameters. What if we could use statistical analysis and find the highest price range in the shortest hold time? What if we could find areas of the city where we have the most and least price volatility, depending upon what we chose as an investment strategy? And what if we could use it in a way so that in 12 clicks and less than a minute, we'd have all the sales in Las Vegas listed anytime we wanted in order of zip, close date, subdivision, address? What if we did a few more clicks and we could see the days on market, sales price, square footage? This is like MLS on steroids, but for investors. And ultimately, we can filter by date, by subdivision, by address, by price range. Any metric that we want to search by, we can do. So imagine you get a color-coded chart like this, where it tells you, based on vacancy rate, where the lowest vacancy is in the county. Look at here, 0 to 7.99%, and there's only one zip code, 89145. All right, so that means that could be good. Well, what if you could look not just at vacancy, what if you could look at rent rate? Bang. So now we look at that same 89145. We know from the previous slide it has the lowest vacancy, and we know from this slide it has the second highest area in the county in terms of rent. Well, that's like cheating. Now we can focus on that zip. Well, what if we also wanted to drill down by subdivision? We can do that. What if we wanted to look at each subdivision in terms of its historic appreciation and its current decline? Let me give you a few examples. Spanish Trail, beautiful area, very high-end area, dropped 39% from 2007 to 2010. You've probably heard of Summerlin. Most people have, 43%. Aliante, another nice area, 49%. This area I like a lot. Anthem Highlands dropped 54% from the peak in 2005 to 2010. Now remember that the total market dropped 63%? Well, here's some of those that were more than 63%. Lake Las Vegas, single-family homes dropped 71% from 1.13 million for a home to 332,000, and it's now even lower. How about the MGM Grand Residences? These are beauties, but unfortunately, what used to sell for $650 is now being sold for $165, a 75% decline. Now, obviously, it doesn't get any worse than a 75% drop, right? Wrong. If you were to look at the condo conversions called the Meridian that were done not far from our office. Our office is on East Flamingo. That's where we're corporately headquartered for tax reasons and also because we love this market. But if you go down West Flamingo, there is a condo conversion where there were 680 of them converted, but unfortunately not all of them sold quickly. Some sold at $625,000 in 2006 and now at 106. And guess what? Just when you thought it couldn't get any worse, remember how I showed you single-family homes in Lake Las Vegas? These are attached or condos. An 86% decline. Unbelievable. Now, obviously, it can't drop any further than that. I mean, you're buying at 14 cents on the dollar, or if you're like me, you're buying at even less than that. Can't get any worse, right? Well, not quite. How about Echelon? This is a mid-rise project where there were 372 units planned, only 64 got built, and I actually bought some in this development. And I'm not even going to tell you, but it was a lot less than 62.5. Unbelievable. Now, there's a sort of risk associated with buying an uncompleted development, but when you're buying for less than the cost of a car, it's almost incredible. Well, at the end of the day, I know I've covered a lot tonight. I know it was like drinking out of a fire hose. I appreciate that. And yet I'm going to finish up in the next couple of minutes by telling you a few things that you can look forward to. We're at the end of part one, but at the beginning of part two. Remember how I said that I couldn't put 10 pounds of stuff in a 5-pound bag? Well, I agreed with Jason to do a 2-part webinar. And this was part one. America's on sale in the 6 ways to profit, and we covered the first and the second ways. Well, what if I could share all the deals that we did in 2011? What if I could share with you some of the really juicy profits that were made? And we made money on every deal we did and have for the last 30 years, but especially in 2011 when the economy is in turmoil. Well, I'm also going to share my 2012 plan for more, which I think you'll really find interesting because it'll allow you to decide for yourself how you can have more too. We're going to do this 2 weeks from tonight. So Thursday, February 16th at 6 p.m. or at 9 p.m. Eastern Time, you're going to be able to register. And in fact, I'm going to send you an email within an hour after we get on this call. So if you do nothing after you leave this call, hang around for 30 minutes or maybe a little more until I can get the download from GoToWebinar about all the attendees on this call, and I will send you all the invitation before you forget. I'm telling you, you don't want to miss it, and you're just going to have to trust me, because here's what I'm going to cover. The first thing I want to cover is the keys to making more passive income in the next 12 months if you've got money but you don't have the time or knowledge. Number two, something that I found out over the last 2 years, and that is how to export riches in the niches. How can you make a boatload of money? So I'm going to show you how to generate $14,000 in cash flow off one single family rental property in 1 month. I'll share with you the best strategy that I know of for maximizing returns and minimizing risk today. And I'm also going to share the 6 F's of real estate. And there are 3 of the 6 that are really critical. In fact, let me share them with you real quick. Anytime you're in real estate, you're doing one of 6 things or any number of these 6 things. You're trying to find it, fund it, fix it, fill it, flip it, and have some freaking fun. Well, actually, I guess freaking fun would make it 7 F's, but you get the point. There are 3 of these that are most important, and I'm going to talk about them when we get on the next call. In addition to that, I want to talk about cash flow and appreciation. You see, 5 or 6 years ago, you couldn't find anybody who could spell cash flow, and in the last 3 years, you haven't heard anyone use the term appreciation other than me tonight. I'm going to tell you how each of them contribute financially to your future and your retirement, and I promise that it's going to surprise you. We also know that there are 50 states, but as I mentioned before, there are 4 states that actually will allow you to add a 0. The rest of them are just states. And there are opportunities that are presented by ethnic and aging or demographic shifts that are huge right now that you should be thinking about. There are certain cash and wealth and keep it strategies. Remember the strategies I talked about as part of the money game? I'm going to give you the exact ones that I'm using. And I'm going to give you more unfair research. But mostly what I want to do is I want to talk about all the purposeful action that we took that allowed us to basically cheat in a legal way. But it felt like cheating because we were taking so advantage of America while it was on sale and not in a bad way. And I may even have another great joke for you. So part 2 is going to be talking about deals that were done, the juiciest profits, the 2012 plan for more, how you can have more yourself. It's going to be 2 weeks from tonight, so make sure you got it on your calendar. And it would be sooner, except that I'm traveling for the next week or so. And I'm telling you, you don't want to miss it. So here's your homework assignment for tonight. This is it. It's the easiest homework assignment you've ever gotten. Be on part 2. And the way to be on part 2 is to register tonight. So look for the email that I sent, click on it, register, be done with it. It's not rocket science. The other request I'd make is just refer others. If you found value tonight, help me educate 100,000 people each year. It's my goal to do good by helping victors become just that as opposed to victims the next time around. And if you'd like, I'm going to give you my contact info and you can tell me what you thought. You know, I love testimonials, but I don't want you to feel compelled. In fact, you can send them to me. You can send them to Jason. You can even send them an email and say that was the most worthless thing I've ever seen in my life, and it's not going to hurt my feelings because I'm going to do this anyway. I know this whether I share it with you or not. My goal is to add value to Jason and to add value to you by providing you what I think to be great education at no cost. And it's all the education I would have ever wanted when I was at the point that you're at in your career. So I've set up a specific email, PBI, that stands for Purpose-Built Investments, SOTU, that stands for State of the Union, so pbi.sotu@gmail.com. If you've got a boatload of money that's burning a hole in your pocket, let me know. If you've got a screaming deal, let me know. If you want to just tell us how good or bad you think we're doing, let us know. At the end of the day, I'd love to be able to share with Jason what you think, and you can email me there, or you can email Jason directly. So that's about it. I promised you that it would take about an hour, and I think I've run over a little bit, but I hope you found it valuable. And Jason, I'm going to invite you to give me any 2 cents that you've got before you get off, and any other thoughts that you have to everyone before we hop off here.
My brain is still on fire, so all I've got to say is great information, Dave, and you'll definitely see me on the next part 2 here. And I highly recommend everybody that's still hanging on be on the next call. This is going to be the meat and potatoes of everything that leads from part 1 to part 2. So we'll look forward to seeing you in the next couple of weeks. But let me know if you have any questions.
Perfect. I appreciate you, Jason. Thanks a lot. And to everyone who tuned in tonight, I'm grateful, but not content, which is a philosophy that we have at PBI, and I hope you're grateful, but not content as well. We will see you in a couple of weeks, that is. And Jason, thanks again for everything. I appreciate you, bud, and take care. See you all later.
Thank you, Dave.
Bye-bye.